My name is Max Gagliardi, and this is the Talk Energy Podcast. If you're watching this video, take a second, hit the subscribe button on YouTube, or you can follow me on your favorite podcast app, leave a review, help the cause. I'd really appreciate it. This episode's guest is Daniel Frumkin, the head of research and content for Braiins Slushpool. Slushpool is one of the oldest mining pools still in existence and has been a pioneer of the space since the early days of Bitcoin. Dan started out his career researching and writing about Bitcoin till he landed a job with Braiins in 2019. Working for one of the OG Bitcoin mining pools, Dan's been able to learn the intricacies of Bitcoin mining from some of the sharpest minds in the industry. This episode is a technical discussion about Bitcoin mining. We talk about the history of mining pools and how that industry is evolving. We discuss the different types of Bitcoin mining hardware and how firmware is going to continue to play an increasingly important role in the profitability and efficiency of Bitcoin miners. And lastly, we talk about what the most important operating metrics that Bitcoin miners should pay attention to and the other critical issues to consider when planning a Bitcoin mining venture. Hope you enjoy the show. Dan, welcome to Talk Energy. Thanks for coming on.
Thanks for having me, Max. Excited.
I came across you recently, just some of your writing that you've been doing, and I really enjoyed it. And I think I tweeted, I was like, man, this is great stuff. And I'm always like, I'm craving more mining content, especially technical stuff. I think it's hard to get past kind of the surface level, headline things that you read or just generic things you read about Bitcoin mining. But when I see an article or I see some technical writing out there, I'm immediately just trying to go in to consume it. So I just want to start off by saying I really, really like what you're doing. And there's just not a lot of content out there like that, quite frankly, in terms of the what you see like normally. And, real quick on my background, I've kind of focused in the energy space, and I've focused on infrastructure in energy, specifically around kind of this idea of how do I monetize energy. And my background is primarily oil and gas and a lot of natural gas, since oil is a little bit easier. You can truck it. It's got less complexities. Natural gas is fairly complex. You have to transport it, process it, convert it into power if you're, at the end markets level. And so then as I started learning about Bitcoin mining, it became this very fascinating other way to build infrastructure that then monetizes energy. And so it very much clicked with me early, just because it was, man, this is something that in theory kind of fits into my background and my skill sets. And so it's been something that I've been very interested in. And so I'm just trying to do more content with it. And I think this is technically an energy podcast, so people on the energy side, at the end of the day, Bitcoin mining is converting energy, it's consuming energy, it's upholding this network, and it's turning it into a store of digital wealth or digital asset, however people want to categorize that. But what I'd like to start out with is just a little bit on your background for people that may not know how you got into writing these articles, and we can plug where to find those pieces that you've done. And then from there, maybe a bit on your company and a bit about then we'll move into kind of how pools work and some of the things around mining pools. And again, like some of the people listening to this in my audience probably don't know hardly anything about how this works. So I think that's kind of the order of operations here for this first segment. If you want to just tell me a little bit about you to start.
For sure. So my background is actually in mechanical engineering. I studied at the University of New Mexico for 4 years, graduated in 2016. And I was going down the Bitcoin rabbit hole that year, my last year in university. As soon as I heard about it and started taking it seriously, it was basically like all I was doing. I was sitting in the back of my classes and just reading articles, listening to podcasts, always had a headphone in, pretending to pay attention to the professors whenever I had to. But it was just all Bitcoin. So when I graduated, I had been working an internship, and it was fine, but it wasn't something that I was happy waking up every morning to go do. And I just kind of started thinking about my future, 10, 20, 30 years out. Do I really want to do something where, if I worked at NASA or SpaceX or something, that would be a different story. But I wasn't super well credentialed. I did well at the University of New Mexico, but it's UNM. It's not like Stanford or anything. So I wasn't expecting that I'm going to get those jobs that every engineer wants. And I was just thinking about it and I'm so much more passionate about Bitcoin than I am this other stuff. I should take that seriously. And before I get into the engineering world for real, beyond this internship, because as soon as I start making that money, there's no going back. I know I'm gonna get used to having kind of money, and then I'm
Right.
not going to want to go do something else. So instead, basically what I did, I had been to China a few years before and I'd really liked it. I had a good time. And I just thought, like, I have a few months of savings. I can spread that out to many, many more months if I go to China because it's so much cheaper. I can try to learn Chinese and like build out another skill that I can use for professional development. And I'll just like figure something out. Like, I don't know what I'm going to do, but I'm going to figure something out because, the corporate engineering job just doesn't seem like it's going to be the right fit for me, even though I spent
Yeah.
4 years getting the degree. So I ended up moving to China and, first couple of months didn't find any work. Learning Chinese didn't happen that quickly. So I ended up just, I got on Upwork and started doing freelance writing. And I was just writing, like whatever anybody would hire me for, I was taking it because I have no experience with professional writing. I was doing like probably $4 or $5 an hour work, which is actually pretty decent in China. And then I started seeing on Upwork, there were people looking for writers on cryptocurrencies. So then I was like, okay, this is the route for me because I'm actually really passionate about that. Like, this is how I get paid to learn about stuff that I already want to be learning about. So I applied for every single cryptocurrency related job that I saw on Upwork. I got a few of them. Eventually I started working for a media publication and I was doing more technical articles for them. And I was making a decent living, not by no means great, but, I was paying my bills with that for, 2017, 2018, and into early 2019. And while I was doing that, I was traveling around. So in early 2019, I moved to Prague and I was on the Prague subreddit, just commented something there about, like somebody posted about cryptocurrency meetups. And I commented, I just moved here, but I'm super into cryptocurrencies, especially Bitcoin. I've been working in the industry for a couple of years, would love to meet up with anybody. I get a DM, like I think later that day from somebody who was at Braiins, which is the company I now work for, which is a Bitcoin mining company based in Prague. And they operate Slushpool, which, I had heard about Slushpool before this actually, but I had no idea any background information on it. Anyway, so they contacted me. They said they were looking for a technical writer. I went in for an interview. They hired me for like part-time work doing the technical writing stuff. And I did that for a few months. And I think sometime like I started there around March or April 2019. And sometime in the summer, they just like came over to me and asked me to help out with some marketing, copywriting stuff. I was like, yeah, sure. That's not my thing, but yeah, I could do it. And it turns out, I guess that is my thing because it went really well. They really liked the work. Apparently they had hired some copywriter in the US who didn't know anything about Bitcoin. So just the fact that I had the background both with the company and understanding the technology and stuff, it went super well. I got along well with the marketing manager. And so I ended up gradually doing more and more of the content. And where I'm at now is that I'm the head of research and content for Braiins. So basically, most of the blog articles that we put out, most of the tweets we put out, our website copy, our emails, all that type of stuff I'm doing. And then I'm also doing like some research in the background on different technology vectors of
here in a second. But how do you gain the knowledge that you get to do the writing that you do? I mean, there's just so much out there nowadays, and especially in the cryptocurrency world, when you have all the different altcoins and just all these different experts. I've been primarily focused only on Bitcoin. I've done a little bit of research on the other coins, but primarily, my focus is Bitcoin. Just in terms of, I understand the way that it works in terms of the scarcity and in terms of it's just what I focused on, and I don't see the properties that are in Bitcoin and these other coins, and so I focused on it. But if you look out there, I think it's hard for the average person because there's just so much. There's a tsunami of different information around these different coins, and people that seem very official and that talk very officially, and that proclaim to have technologies and things better. There's just so much. And so as somebody that's trying to research and get into this world, and even today with what you're doing, writing about some of this technical stuff on mining, I mean, how do you do your research? How do you, when you find something you want to dig into, dive into, what's your process there? Because when I read your writing around mining, it seems like you've got a good grasp of all this stuff. I'm just wondering how you go about it.
Yeah, so when I got started, I was like mostly writing about altcoins because that's where the money was for marketing perspective. And in 2017, like I didn't mind that at all because it was like everything was making money. So I thought I'm getting paid to learn about the things that are going to make me a ton of money. And then I bought some and then I rode them through the crash. And then 2018, I was like, okay, it's Bitcoin only. The rest of this is trash. As for how I learned a lot of this stuff, the great thing is that the two co-founders at Braiins, Jan and Pavel, they've been around since 2013 in the Bitcoin mining space. They're both engineers.
That's awesome.
And they're brilliant guys, and I get to pick their brains a lot of times. So, like I've tried to be as much of a self-starter as I can, but whenever I have like something that is difficult to find online, I can always just go to them, and they almost always know, whether it's something super technical or something about like the mining economics. Like they're just really well versed in everything to do with the industry. So I've been able to learn a lot from them, which is one of the best things about being at Braiins. And then also Edward, our head of business development, he understands like he worked in China for I think a year and a half or 2 years in the mining industry. So I was always picking his brain as well to learn about more of the business dynamics of the industry. He's in touch with a lot of different mining companies and major players in the space. So he gets to tell me things that probably most people would love to know, but they're just like confidential things. So between those three guys, I have like pretty good access to information that most people don't, which is one of the best things about it.
That's the best way to learn, I think, in business, is to have these mentors or to have these people that you can bounce things off of. And this is an analogy that resonates with me personally. I don't know if any other people will relate to this, but growing up, the main sport I did, and I'm from Oklahoma, so I was a wrestler growing up because that's the big thing here. And I remember when I got really good is when I realized that wrestling the best guys in practice, the guys that were the guys that would beat you every single time, because that's how you learn, was being around people that know a lot more than you and forcing yourself to interact with those people. And maybe that's not a perfect analogy, but I've seen it in business as well, where, you know, if you really want to learn more and you find the people that are the experts, and, you know, be smart enough to recognize that what you know and what you don't know, find the people that know what you know and befriend and work with those people and try to add value to those people like you've done with the content things. I think it's really cool. And to see a guy, I don't know your age, but you seem like a young guy. And so I think that the amount of knowledge that you're gaining right now is pretty awesome. And so that's great stuff. And what I'll move now into is just kind of your company. I mean, for people that, you know, I think there's even people in the Bitcoin world like that aren't into the mining side, but certainly people in the energy space. Just kind of walk through what a pool is and Slushpool in general. And then, I mean, you can talk high level Braiins, but then specifically I want to kind of get into what pools are, how they work, just for people, you know, again, this is kind of one-on-one for people, but just it'd be interesting to hear you explain it.
Sure. So the origination of the mining pool was in 2010, which the reason for that is that a lot of people started to mine with GPUs around that time. And actually it was just a lot of people started to mine in general. So in the first year or so of Bitcoin, there were only a few miners. And so it wasn't such a big problem that there's only one block reward on average every 10 minutes. And that only one person is earning that block reward. So if there's 100 miners and there's 144 blocks per day and each miner has roughly the same amount of compute power, then every miner is probably going to earn revenue at least like once per day. They're going to find at least one block per day. But as soon as you start getting into hundreds of miners and thousands of miners, and some miners using more powerful hardware like GPUs, then it becomes a case where you could have a single computer mining, and you won't find a block for 2 weeks, 4 weeks, 10 weeks, whatever. But you're burning the electricity the entire time. So you have constant costs, you have constant OPEX, but you don't have constant revenue. You have very, very infrequent and high variance revenue. So the mining pool idea comes from, we need a way to make it so that people can still mine even if they only have like one little small computer that's 0.1% or 0.0005% of the entire network. Because ordinarily that person's not going to find a block more than once a month or even less frequently. But they're still consuming electricity like everybody else. So they need some way to stabilize the revenue. So mining pool is just an aggregator of the compute power, and it distributes the mining rewards proportionally to the amount of compute power that's being contributed to the pool. So if you have like 1,000 miners that each have 0.1% of the network, you get them all together, then you're at least going to find like probably 1 or 2 blocks per day. And then you can distribute the rewards between those 1,000 miners, and they're going to be making enough money that they can cover their electricity bills every day, assuming that they're mining at a profitable electricity price to begin with. But the mining pool is just a very simple, stabilize the revenue stream so that it's a sustainable business model for people who don't have 5+% of the network hash rate.
What's interesting to me about the mining pools is when I first heard about it and I was understanding just kind of the basic principles of Bitcoin and the network, everybody's very focused on decentralization. It's the thing that guys that are really serious about it, they want to make sure that the network is decentralized, that there aren't any kind of attack vectors or things that are centralized. And you fall into the arguments around the block size and all these other things. And when I first thought about mining pools, I was like, that's kind of weird. Like everything's focused on decentralization, but you've got all these people into a centralized kind of apparatus, which is now controlling things. But then I thought about it a little bit more. And I guess if you didn't have the mining pools, what you would probably end up having is like big mining companies that effectively you just have a couple monopolies, and you wouldn't, if you were a pleb or somebody that just wanted to plug in your own machine or add a little bit of hash rate, there would be no way to do that and do it competitively. And so in some ways, although it does centralize into these mining pools, it's actually kind of brilliant because it allows like every single person, like all these individual people, to just put a little bit of computing power in, and then they can then be part of the network. And so do you know, is there anybody specifically or group specifically who were the first ones? Just a little bit of history on kind of how it formed. Was there any resistance early on? And do you agree with my characterization of what it does for people?
Yeah, I agree with it exactly. We did a thread from the Braiins Twitter account a week or two ago about the idea of decentralized mining pools, and we got into that like the fact that you can be earning this revenue through a custodian basically in the mining pool makes it so that smaller miners can actually get large enough balances that their UTXO wouldn't be dust. What that means is like that if you're a miner who has maybe one old gen machine that you're earning maybe $2 or $3 a day of BTC, in order for you to get that payout from the pool, you can mine for 2, 3, 4 weeks and be accumulating it so that your payout from the pool is actually at least like $30 or $40 as opposed to it being $2 or $3. And that's important because the way that the blockchain works is it's a ledger of balances of these unspent transaction outputs. So if you get a $2 unspent transaction output and the average fees at the time to get it into the blockchain is $2, then like that's basically unspendable.
Right.
So yeah, mining pools are for small miners, and I totally agree that if not for the existence of mining pools, it would just be like a few huge publicly traded companies that are super well capitalized competing with each other, and it would be a lot more centralized.
Yeah.
As for the history, the background on it, Slushpool is the first like successful mining pool implementation in the world. It was founded in 2010. I think there's a Bitcoin talk thread in November 2010, and then the pool mined the first block in December. There were other people trying to do mining pools before that. I think like October of that year. And maybe one or two of them actually did mine a block or two, but they like, I don't know if they ran into technical issues or they just like didn't get enough people using them or whatever. But, basically the other ones that were started around that same time in late 2010 didn't last very long. And Slushpool is the one that did, make it out of that. And then I think around 2011, 2012, some other pools started to pop up, and most pools like have come and gone. Slushpool is one of the few that's been around for a really long time. I think F2 pool has been around for maybe 7 or 8 years as well. But most of the mining pools today are actually relatively new, which I don't know if we want to get into that, but the reasons for that is that the mining pool business has been turned into basically a supplementary thing for other things that mining companies want to be doing. So for example, exchanges like Braiins started a mining pool and they're operating the pool at a loss. And the reason for that is that they care more about getting miners to use their exchange than they care about the actual mining pool, because the exchange is a much bigger business. There's also like Foundry is all about equipment financing. So they started a pool, which presumably they're operating at a loss as well on the pool side, but the miners that are using their pool are probably also using them for equipment financing. So like the mining pool business has evolved a lot, especially in recent years, such that like it's no longer a viable business model on its own. And, all the mining pools are needing to innovate, which is the same thing we're doing at Braiins, where like Slushpool has become kind of one of our products, but our big focus is more on the firmware.
Yeah, let's talk about that. I've got a bunch of questions about actual mining stuff, but I'm still interested a lot in the pool side of it, because my background has been focused on the hardware side around, again, energy infrastructure. So, we've looked at a lot of different projects, and we've helped work on a few projects where we're looking at natural gas generation for power primarily, and we're looking at the generators. We're looking at building, for example, mobile units that you can mine in rough terrain. The oil field is hot, it's dusty. So a lot of my focus that I've thought about these problems and how to solve them has really been more on the, I guess you'd call that hardware side and the physical assets side. I don't have a good grasp on when you plug the machines in, what's happening, how it interacts with the pool in terms of, is it easy? Is it just you say, hey, look, we're going to sign a contract with the pool, and then we just direct our hash rate at that pool, and then you get it distributed pro rata to a wallet, I guess, as I'm assuming. I've just never been in the weeds on that side of it. And then so kind of walk through that, as if you're a miner, you just bought some machines, how do you interact with the pool? And again, this is kind of 101, but for me, it's interesting because I've not been in those weeds. And then we'll move more into some of the mining metrics and some actual more technical stuff here in a minute.
Sure. So setting up with a pool is even easier than you sign a contract and all that stuff. The big players do sign contracts because they get non-standard fees. But if you're just somebody who bought 1 or 2 machines and you're plugging them in your garage and you want to join a mining pool, you basically go to the mining pool website, you get a URL, and you paste that URL into your firmware user interface, and you save it, and you're good. Like it's super, super easy, which, going back to the point of like this being a vector of centralization or decentralization, the fact that you can very, very quickly change pools, or you can even mine with multiple pools at once if your firmware enables it, makes it so that pools are not a very high risk attack vector. That kind of changes a little bit if all of the pools are in the same place. So there's been a historical dominance of Chinese mining pools, especially since like 2013. So then you could get maybe a few of those pools together, and then it becomes an attack vector if you can control like 3 or 4 of them at a time, the 3 or 4 largest. But in general, if miners are, for whatever reason, unhappy with their pool service, it takes a few seconds to switch to a new pool, because all they have to do is go get the different Stratum URL, which is Stratum is the protocol that miners communicate with the pools through. And so you get a URL for the pool Stratum endpoint that you connect to. You paste that into your user interface, and you start mining with them. So you can just go get a different pool's URL, paste it in, and redirect your hash rate in a matter of seconds.
That's awesome. Talk a little bit about the user interfaces and the firmware, what you guys do, and then just in general, high level about how it works and how it interacts when you're mining.
Yeah, so the firmware is a really interesting part of the mining industry, because it's like hardware has been being optimized like throughout Bitcoin mining history to the point where now we're starting to see diminishing returns on it.
Right.
Like the efficiency on the hardware side, like 2016 was an Antminer S9 that had an efficiency of about 98 watts per terahash. And then the newest gen machines released in 2020, 2021 have about 30 watts per terahash. So it's still a significant improvement, but maybe like the next generation is going to be 25 or 20 watts per terahash. But ultimately, like hardware is getting commodified to the point that there's not a huge competitive advantage to be gained from one generation of hardware to the next. Firmware is really cool because like what Braiins OS Plus does, which is our auto tuning firmware, is it basically optimizes the hardware performance by tweaking things like the frequencies and voltages. It's an optimization function where it tests out different frequencies and voltages through the chips, and it figures out where the chips are higher quality, and then it assigns more work to the higher quality chips. So the end result of that is that basically you download some different firmware onto the hardware, and you can immediately improve your efficiency 10 to 20%. And you don't have to pay anything up front for the firmware. Like firmwares like ours collect a development fee, which is a portion of the profitability uplift that we provide. So this is like a new vector for optimization for miners, where like we're starting to see the hardware side is plateauing a little bit, but the firmware is a way to get a competitive advantage now.
Does it do you guys do the user interface too, or how does that work?
We have a user interface where you can control all kinds of different things. You set your power limit, which is the biggest thing. So for example, with the Antminer S9, which is the 2016 generation of hardware, a lot of people now are mining with those in their houses. And residential electricity prices are higher, so your efficiency matters a lot. And then also miners are extremely loud, like 60 plus decibels. So one of the reasons that people are using Braiins OS Plus in that case is that they can actually bring the power limit on that machine down from what the stock power limit would be of like 1200 watts or a little bit less than that. And they can bring it down to 800 or 900 watts, and it runs much, much quieter and more efficiently. So that it's not like if it's guys with wives that are pissed off that they have a super loud, computer running 24/7 in their garage or whatever, then like it's a solution for that, because you can really control the power limit within the range that the hardware is capable of operating at. So that's the biggest thing on the user interface.
That's awesome. It's interesting to me. Is there anything that's like I guess do you guys also just have analytics involved too? Like past analytics around performance, future analytics around projections or anything like that?
We're able to collect telemetry data through the dev feed channel. So where we collect the hash rate from for our development fee, we're able to see like performance metrics from the ASICs. And it's not exactly 100% accurate because basically we're estimating the power consumption. The only way to know for sure is to measure it at the wall. And
to meter
right.
it.
So we don't like to publish that data for one, because like we don't want, we just don't want our competitors to be able to glean any insights and stuff. And, but more importantly, it's just like the data is not 100% accurate. And we already explained to people like every single mining device is a little bit different. It depends on how it's been, if it's been used before, how much it's been beaten up before, the quality of the silicon and the mining chips to begin with. All these different factors go into, how well that hardware is going to perform in the first place, and then how much we're going to be able to improve the performance with the auto-tuning firmware. But so generally, like our data looks like these, it's more like a ribbon than a line in terms of we'll have the power limit on the x-axis, we'll have the hash rate on the y-axis, and then across these different power limits, we can see the user input this power limit, so we know the power consumption is somewhere in that range, and then we can see that the hash rate being measured is like somewhere in this other range that is a little bit more accurate probably than the power consumption reading. But we don't know for sure on either of those metrics exactly what it is. So we just have like, here's where 90% of the hardware lands, here's where the top 10% lands, here's where the bottom 10% lands, stuff like that.
Is there any, that's interesting. Is there anything out there, and maybe it exists, but in my head, I've been thinking that it would be really nice to have some type of program or software that miners could use, whether that be professional groups that want to mine professionally at a larger scale, whether that be individuals that just want to do it on the side or as a hobby. Is there anything out there that helps people plan the economics around, what it's going to look like? So for example, put in all your inputs. I mean, I know there's Excel models, obviously, we've made them and you can get them from people. But in terms of just like a product or something that, someone could log on to, and maybe it's cloud-based. I don't know. In my mind, I'm thinking of something that would be like a dashboard, and you could do your inputs and it would show you your outputs. You could make economic forecasts, or maybe even you could tie a program like that to telemetry if you did have a metering at the power side, and kind of put it all and package it all up into like a dashboard or something for people to use for decision making around analytics if you're looking to get into mining, or if you want to optimize. Like, let's say you got 3 projects for mining, and here's project 1, 2, and 3, a product that you could put all these inputs into, and it would give you kind of forecasts or analytics around the economics. I mean, I don't know if something out there like that exists, but in my mind, we've done a lot of it in Excel, and it's for guys that are trying to learn the space. There's a lot, and there's a lot of metrics and things like that. I just wonder if there's anything out there like that.
I don't know of anything that packages it all together super well. One of my projects at Braiins for the past year has been mining insights, and included in that is a profitability calculator, which I think is probably the most advanced one in existence in terms of all the different inputs that you can put into it. An Excel sheet obviously gives you a lot more control, but part of the difficulty with that is if you don't understand the mining economics to begin with, then building the Excel sheet is really difficult. And then let alone like confirming that you have everything accurate and whatnot. Yeah. So, this profitability calculator that we have, it doesn't like take any live data inputs from actual hardware, it would be really cool if it could do that. I don't know if, maybe eventually we'll like integrate it with the Slushpool dashboard or Braiins OS Plus dashboard.
You should do that.
That would be really
sweet.
Cool. We're integrating the code into our mono repo now, so it's possible. Maybe in the distant future. Yeah.
Well, I think about it from like the oil and gas space, and I know there's been a lot of tech innovation. And oil and gas is kind of, for as advanced as it's been in the tech around extraction, the technology to unlock more reserves. And that makes sense, right? Because that's where the big CapEx dollars are spent on like drilling and completion. Wells can cost, $8-10 million a piece. And so when the majority of the CapEx is going into those functions, that's where the majority of the innovation is happening. But around just kind of like the data side and the analytics side, I know there's groups that work in oil and gas around pulling real time, like SCADA telemetry data from how wells are doing, and they're feeding that into a system, and you're tracking that in real time. I think that there's groups trying to build, whether it's through like, you see it at company levels doing like things in Spotfire, dashboards or whatever to put analytics together. I just think for mining, it would be really cool to me if like a lot of the work we've had to do manually, if there was just a program that you could, pull up and just toggle all these things and use it for forecasting, use it for project analytics. The profitability calculator would be part of it, obviously a huge part of it, but I think that there is a niche for that, and a group like you guys could probably be somebody that would have the knowledge and the tools to put something like that together. I think it would be hugely beneficial for big and small miners.
Yeah, as you're talking about like the oil and gas stuff, it reminds me there are definitely some companies with like maybe 80% of what you're describing, where especially in Texas, where they're integrated with the ERCOT system, they have like tons and tons of data inputs, because they're also determining how much power they need to consume in any given moment, based on like current residential or grid electricity prices, grid supply and demand, and acting as controllable load resources. So in those cases, I know some companies based in Texas have some pretty advanced proprietary software for taking in all those inputs, both from the energy supply side of things and from the demand side of things, how much they're going to consume, and then connecting that to some sort of mining farm management software, so that they can easily adjust how much power they're consuming and which machines are on and et cetera. So that's definitely, but those are like the multi-million, or in some cases like hundreds of millions of dollars, well-capitalized mining companies that are able to develop that advanced software. But I think for the at-home miner, it would be really cool to have something accessible as well.
Yeah. Well, I think guys like that, especially if you're like on ERCOT in Texas and doing like the demand response stuff, things where you're having to analyze and kind of, virtual real time or close to real time as you can get around, when am I pulling power? When am I selling power back? And what's my profitability? I mean, I would think that they would have to have some kind of proprietary models that they're running, at a minimum to make an operation like that work. And so, and I could talk about this a lot because it's interesting, but I want to be mindful of your time, and we're coming up here on about 2/3 of the way. So, look, I think what I'd like to talk about is kind of the metrics around mining. And if you look at, a lot of people focus on the OpEx side of it. And there's a lot of different ways to look at it. People look at cents per kilowatt hour. People look at some different things. But before I give you all of my opinions on it, what are the most important metrics to you when analyzing a mining operation? And just I'll kind of leave it at that, and then we can keep going on that topic.
So when deciding whether or not to mine or not, the number one metric is definitely electricity price, because if you're above a certain threshold, I would put it at maybe 6 US cents per kilowatt hour, then you might not be competitive long term. So it's just a non-starter. But once you get past the point of you have competitive electricity prices, the two metrics that I think are the most important are hash value and hash price. So hash value is the BTC that you would mine per terahash of hash rate per day.
Right.
And the hash price is the dollars per terahash per day. So just multiplying hash value by the current BTC price. So the reason that those metrics are so useful is that mining revenue has really three big factors that create short-term and long-term variance. One is Bitcoin price, of course, because you're mining Bitcoin, your bills are probably denominated in local fiat currency. So how much you have to spend on the OpEx side and paying back your hardware potentially. It really depends what the BTC price is, how much of it basically you get to keep, versus how much of the BTC that you're mining you have to sell in order to cover those expenses. So price is obviously the biggest factor. But long-term difficulty is also a huge factor. So difficulty is the mechanism that balances the entire network basically, because as the amount of compute power mining goes up, the difficulty goes up in order to maintain that average 10 minutes per block being mined. So maintaining the issuance schedule long term. So basically, whenever people are doing mining projections, I always recommend to them to anticipate that difficulty is going to go up by like roughly 6% per month, which equates to about doubling every year, which is actually less than has been the case since 2016.
It's like 8% or something historically. 8% or something.
Yeah, something like 8% since I consider like 2016 kind of the beginning of the modern mining industry, because the Antminer S9 was like the first piece of hardware that was really durable and had a multi-year lifespan of profitability, and it just completely changed the game. So like in this modern mining era, 6 to 8.5% monthly difficulty increases. And what that just means is that the amount of Bitcoin that you're mining every month goes down if your hash rate is staying constant. So you have to anticipate and so this brings up another really, really important factor in mining, which is that the way the industry works, you pay for your hardware up front. Maybe you have financing, so you have a loan and you're spreading out the actual costs over a long period of time. But the hardware supplier or the manufacturer requires payment up front before they even ship you the hardware. So this basically means that you have this massive capex, or relatively speaking, depending on how many devices you're buying, you have this really large capex, and then you have a wait time where you're not making any money from it yet. And sometimes that wait time can be very long. For example, a lot of the publicly traded mining companies in North America were buying hardware with 6 to 12 month wait times because there was such a supply shortage from the ASIC manufacturers in 2020 in particular. That like they purchased hardware in late 2020 that's still being delivered now. So obviously the value of the hardware can fluctuate a ton in that time, but then also that entire time that after you've purchased the hardware, but you're not mining with it yet, you're basically just watching difficulty go up and up and up, and the amount of revenue that you can earn in Bitcoin terms going down. And that's like a painful thing for miners, but it's just the reality of the network. And this year has been particularly interesting because it's the only time in modern mining history where difficulty went down for a reason besides the profitability of mining being like margin shrinking, because margins were going up and up and up as price was going up, and there was tons of hardware scheduled to be coming online, but then mining got banned in China, and roughly half of the hash rate on the entire network just went offline in a matter of about 6 weeks. And then difficulty responded to that by going down almost 50%, which means that all the people who were mining during this time were earning like 2 times more revenue in BTC terms than they were expecting to if difficulty trended the way that it typically does. So difficulty is that second factor. The third factor, a little bit less significant now, but will become more significant in the future, is the average transaction fees per block. So this goes back into the Bitcoin revenue side of things. Each block you have your subsidy, which is the new coin issuance. That's currently 6.25 BTC per block. But in addition to that, you also earn transaction fees from all the users' transactions that you include in the block that you mine. So depending on how active people are, how many people are using the Bitcoin network to transact, you can get sometimes, like we're seeing 0.1, 0.2 BTC per block, which is not very significant. But other times, earlier this year, for example, we were seeing 2 or 3 full Bitcoins per block, which means basically 25% extra profitability per block from the transaction fees. So all three of those variables on the revenue side of things have extreme variance. Price, of course, can fluctuate massively on a day-to-day basis. Difficulty changes roughly every 2 weeks, and doesn't typically change that much, but generally it's an up and to the right slope. And then average transaction fees tend to be pretty correlated with price, because as price goes up, more people are using Bitcoin, and transaction fees go up. When price goes down, less people use it, transaction fees go down. So it kind of just actually leverages that, the Bitcoin price a little bit for miners.
It's really interesting. And I think that I've kind of tried to extrapolate this out into the future around how I think it's going to pan out and how mining is going to be in further decades into the future. Because when you first start to think about it, you look at the increasing difficulty rate, and you also think about the halving points where the subsidies cut in half, and you start to think, man, this is going to be a really difficult thing to profit in. And people brought this up to Satoshi, and I think his comment, if I remember correctly, was something around, like all industries are going to, the marginal cost of production is going to trend over time, or a price, that you can pay is going to trend over time to the marginal cost of production. And that's why he designed it with the difficulty adjustment, which people will tell you was the real invention in terms of what made this all click. But if I look at it into the future, so today the industry is kind of this high risk, high reward. If you look at cost of capital, it's almost like, and again, I'm kind of equating it to what I know, which is oil and gas. And so, for example, if you're doing, wildcat exploration wells, which is wells that are very risky, that you have to go out and you don't know for certain if you're going to find a resource or not, then the cost of capital for that is higher. And by that, I mean the cost to borrow money for people that aren't in the finance side of it. So for example, to finance these miners, we're seeing, and we've heard of interest rates that are very high, because it's in theory riskier. And so you've got a higher cost of capital. You've got all these factors that we can't control. For example, the difficulty rate, and then the price of Bitcoin is very volatile. And so those things combine to where if you can time it right and you can buy, and then the capital to buy the hardware is fluctuating, right? And it's almost a direct function of, from what I can tell, the price, all these things you just talked about, those three things, those basically translate into what you have to pay to buy the hardware. And so it's this, everything's got this balance to it. I think as we go into the future, and I would like to hear your thoughts on whether you think I'm wrong here or right, but I see it becoming over time trending, the cost of capital trending down. And this is going to have a couple things. It's going to be, as the price of Bitcoin, as the adoption of the network increases, in theory, the price will stabilize once you get to these higher market caps for all of Bitcoin. And so you start to get more and more people using it, more and more adoption. We're seeing it now with things like the El Salvador stuff, and just, it's everywhere. Bitcoin ATMs at all the gas stations in Oklahoma. It's like you're seeing it all over the place. And so as the network adoption grows and the base of users grows, the price will go up, but in theory, it will also stabilize, or the volatility will stabilize, because it's harder to move, a $10 trillion network 80% than it is to move a $1 trillion network 80%. And so as it stabilizes and as the price goes up, in theory, the mining will become probably less profitable in some ways, because it will be more predictable. And so you won't have these wild swings. And so the cost of capital then will come down, because it'll be less risky. And so people will be able to, you might not make this big, huge profit like you did during the early days when the price could run up and it would have these huge increases, but it's probably less risky and easier to plan. And then that's kind of the middle phase, if I had to think about it. Then the long-term phase is more like so you went from drilling, like, to put it back in oil and gas, drilling wildcat wells, to then doing what we would call like infield exploration or infield development, where you've already defined the play and you're just kind of harvesting the resource, and it's still risky, but it's not as risky. And then you've got kind of manufacturing mode, or almost more like a utility mode long-term. And I think where I see the network going is where the fees come into play. If you really want to look decades into the future, I think the Bitcoin network will be almost just like a toll road or like a utility. People will probably be making very, very steady fees. There's probably not going to be a lot of fluctuation in the price of Bitcoin. There's not going to be very high returns in mining. It's probably going to be kind of single digit returns, and the cost of capital will come way down. It'll be like, building a road or a long haul pipeline where we just kind of know you're going to make this much every month, and there's not going to be this big upside. There's not going to be a big downside. And it's just this kind of steady state. And then you'll see the miners maybe functioning more like banking institutions. Maybe they're lending against maybe they're providing other traditional financial services. And this is kind of more, I don't know if this is really going to happen, but I'm thinking at the end of the day, mining is kind of like you're a futuristic bank. You're processing transactions, you're upholding this banking network. So maybe in the future, if the profits from the actual mining go down and it's more just this transaction thing, maybe those guys then become more like traditional institutions and banks where they're like lending, they're doing other things. Like, I don't know. I'm just wondering how this thing could evolve. That was kind of a ramble, but that's just, I'd love to hear your thoughts on it because that's how I'm kind of envisioning it panning out. But
yeah, I think you nailed it. I'm pretty much on the same page on all of that stuff. Like right now, the big problem for Bitcoin miners, especially when they go to the energy side and they're looking for cheap sources of energy, is that basically if you want to mine right now, you have to be long Bitcoin because otherwise it doesn't make sense financially. If you're putting millions of dollars into the ASICs and you have maybe a 8 to 12 month payback period on those, if Bitcoin price crashes during that time, or if difficulty just shoots up during that time, then you could end up doing really poorly on that investment. So for the people who are investing money right now into mining infrastructure, they are extremely long Bitcoin. I basically view ASICs and mining infrastructure as a leveraged position on Bitcoin. Maybe it's like 1.2%, 1.8%, something like that. But you're very long Bitcoin if you're investing in mining. And like you were saying, I think that amount of leverage will probably shrink over time as price stabilizes at a larger market cap, as transaction fees become more consistent, and so on, and hopefully as difficulty growth settles down as well. And like actually, so one of the cooler things that we're working on at Braiins is kind of trying to accelerate that process so that miners can have more predictable and stable cash flow. And the way that we're doing that is we're building an exchange for hash rate where miners can sell it on a spot market for basically sell it in real time. Or they can also sell it on a forwards market where they could have a contract length of 1 week, 2 weeks, maybe even a few months, where they're earning a predictable amount of Bitcoin during that time period. And then on top of that, we'll eventually build a futures market for hash rate where they can hedge many months out if difficulty goes up, if price crashes, if transaction fees are super low. They can basically they can take the opposite position and go short on hash rate in the futures market, basically to lock in the revenue that is actually predictable to them and makes it much easier, hopefully, to get financing for equipment and infrastructure and that type of stuff.
That's huge. I mean, because like whenever I talk to guys in my space, in the energy space, and we're talking about doing these projects, there's a couple things. One, you're worried about the hardware, and it's like, can we insure this stuff? And I think that there are ways to do it. I know there's more products coming out. And then, so that's like one question. And especially if like, we're looking at doing it, investing in our company, doing it, or just me personally, I've looked at doing it, and it's like significant dollars of your own money. And, when you start to risk those dollars against especially the main thing to me is like risk of loss on hardware. Like that's a big one, especially if you're in like a non-controlled environment, like out off grid, which is mainly where we're focused. And so you're kind of like lightning strikes, floods, fires, whatever. And that's like, risk of total loss. And so that's one thing is insurance. But then the other thing is risk mitigation financially. And so you get a lot of questions around hedging and derivatives and are there products in place to help hedge some of this risk? And so what you're describing, I think it would be crucial to help some of these guys. And this stuff's going to evolve. I mean, like it's going to mature around what people can do to manage their risk. And I think as that happens, it will be a lot more predictable thing for people to do and to want to go invest money in, which again will drive more adoption for mining, which will then stabilize things like we're talking about into the future. And so we're running long on time. And that was a really interesting point and segment. I think lastly here, just on some of these metrics, we focused on, I had two more topics I want to cover. I know it's 10 o'clock. Are you good for going for a little longer, or do you have a hard stop?
Yeah, we can do a few more minutes.
So
I'm okay.
So two things is, one, I just want to make a point around OpEx. I know everybody's so OpEx driven, and as somebody who's going back and looking at historicals, I get that if you zoom in, OpEx is huge, right? If you zoom in on certain time periods, like OpEx is critical. You could be upside down. You could be losing money. You could be not making a return enough to pay back for the hardware that you spent for the capital. But if you zoom out, OpEx is kind of like white. If you're not selling Bitcoin, if you're holding the Bitcoin and you zoom out, you're kind of like, this OpEx stuff's white noise. Like, is it really an OpEx game? Or at this phase of Bitcoin mining, is it an accumulation game, right? Like, is it, hey, I could scale and I might be having a more higher OpEx. And I think this is what a lot of public guys are doing, because I don't think that like the public guys, they flash like, a 2.5 cents per kilowatt hour. But I'm like, yeah, but you have like hundreds of people and all this capital you spent on facilities and all these things. Like, if you roll all these costs that it's taking you to get to that, you're probably at way higher percents per kilowatt hour. But I think for them, it's a scale game to where, like really it's an accumulation game. It's a scale game in terms of this spot where I'm at. And that's what I've kind of tried to think about it is like, yeah, the OpEx is important, but the reality is getting as much Bitcoin. I mean, we got 30 months left to the next halving. Like, I mean, you're losing like 3% or 3 point something percent, 3.2% of the existing subsidies, or that's going away every month and before it halves or something like that. I don't know if that's the right number, but so really, is it an OpEx game or is it just a scale and accumulation game, or both, I guess?
Yeah, two points I want to make on that. First of all, in that profitability calculator that I mentioned earlier, the coolest input that I have on there is called the HODL ratio. And it basically, you can set it to, so if there's a price increment for BTC to begin with. So you can increment BTC price monthly to go up or down. And then you can decide how much of the BTC you're mining you want to hold versus selling it all into fiat, which also is done each month. So if you set it at 100% HODL ratio, then that means all of your profits will be held in BTC. And if you have a price increment, a positive price increment, then it shows that the real thing here is like, can you accumulate BTC and then see that BTC appreciate in fiat terms? Because if you're just mining to sell it out into fiat, you can probably make some money that way, especially if you have cheap OpEx. But like you're limiting your upside so massively, because the real upside here is BTC price, and mining is all about discounted BTC. So the second point I wanted to make is that the way that I try to simplify mining economics calculations is to kind of take fiat out of the equation, at least in terms of the like CapEx part of things. So what I mean is that when you're purchasing hardware or investing in infrastructure, you're spending fiat to do those things. Or at least it's denominated in fiat. You might be sending somebody Bitcoin to buy the hardware, but you put it on your balance sheet as a fiat expense, and then you're mining for whatever length of time, and you're accumulating Bitcoin, and maybe like you're turning a profit in fiat terms each month, so it looks cool, but the real question is, are you going to mine more Bitcoin with that hardware and infrastructure than you could have just bought with the investment in the first place?
Right.
So whatever the price of BTC is now, you like divide your CapEx by that BTC price, and that tells you how many coins you could just buy right now. And if you don't mine that many coins over the duration of your operation, or if you're not projected to based on like significant difficulty increase, then it doesn't really make sense to mine, because you'd be better off just buying the Bitcoin. Where it gets interesting is that obviously there's a lot of people who have control over these large energy generation resources, like I'm sure people that you're talking to, and in the oil and gas side, and in all the different energy producers around the world who are starting to take a look at this, they maybe don't have any belief in Bitcoin long term. So they're looking at it in terms of like, are we going to make money in fiat terms?
Yeah.
And that just doesn't work. It's like, you have to do it to some extent to sell them on them selling you their energy, or them integrating mining and buying your infrastructure solutions like containers and hardware and stuff like that. But the real way to look at it is just in BTC terms. Your OPEX is going to be denominated in fiat, most likely. But the question is, will you mine enough Bitcoin to make it worthwhile versus just buying the Bitcoin up front?
Yeah. What's interesting is, so a couple of things you said there. One is that I've heard when we talk to some groups that may be looking at investment in mining, and they want to know kind of what's your realized, what's your actual price that you're paying for the Bitcoin. So like kind of the metric that you just said, like what's your effective price per Bitcoin, really? So like if you're making this investment in mining, what does that get you? Like are you getting Bitcoin for 25K a Bitcoin? Or are you getting it for 20K a Bitcoin if you invest this much in mining? Obviously that price changes depending on what you pay. The other thing that's really interesting from oil and gas is that if you look at ways to subsidize that OPEX, and so like, for example, if you were a miner in 2020 and you were selling your Bitcoin just to cover your OPEX, right? You're hodling everything else, but you had to sell Bitcoin to cover your OPEX. You ended up spending like 20x on operating costs than you'd planned to spend in Bitcoin denominated currency, right? So it's like you're having to sell that Bitcoin. That's a bad thing if Bitcoin's going up in price, because your expenses now were way inflated in a Bitcoin denominated currency. And so in oil and gas, if you look at some of these fields, you could buy, like, for example, a field of, when I say field, I mean like a group of wells or assets that would be producing multiple revenue streams. So, and a lot of times you can buy, like, for example, proved developed producing assets. It's called PDP. And you could buy it for, say, like a PV10 to PV20. So that means you're basically paying a 10 to 20% discount rate. So in theory, you would get like let's call it a 15% return on your money if you bought this field. Well, if you took like the oil revenue and you sold it and converted it to fiat, and you use that to pay your OPEX for the mining, now you're basically, yes, you had to buy that oil up front in time zero by, buying it today. When you buy reserves, you have to pay like a value today for all those reserves, and it's discounted to today's dollars. But so there's a capital outlay. And I've heard pushback on this thesis around, well, that's just capital that, yeah, you can subsidize OPEX, but that's capital you could have spent on mining hardware. And it's like, well, okay, that's a good argument. But if you had the multiple revenue streams, in theory, you could subsidize the OPEX to where, and this is what the demand response guys say they're doing, right? Is it like, hey, by the way, I'm subsidizing all my OPEX because I'm not having to spend any money on it because I can, play the ERCOT game and get these demand response days to drive that down. And so there's just a lot of interesting ways to play it. I mean, I know some guys are just truly like, buying power or buying energy and then mining Bitcoin with it, and it's a little bit more straightforward. But I think there's more creative ways potentially to kind of play with the way you do these economics through kind of subsidizing it through multiple revenue streams.
Yeah, even us at Braiins, all of our revenue is BTC denominated because we don't take fiat investments. We collect a fee from the hash rate on the pool and a fee on the hash rate using Braiins OS Plus. So we're basically, in revenue terms, we're kind of like a miner in the sense that we have all of our revenue is denominated in, it's all based on hash price and hash value, and then our costs are all fiat. It's just like basically labor is the main cost for a software development company. And so
sure.
we were looking at the same equation, and this year actually we sold company bonds similar to what MicroStrategy is doing, where we just we offered the bonds to the public and some private investors, and we sold enough so that we don't have to cash out any Bitcoin for like a year, or I don't know exactly how long the runway is on that. But we just raised a little bit of money so that we can cover those operating expenses and accumulate 100% of the BTC that we're mining with our dev fee and the pool fee. So I imagine that there are a lot of miners out there doing the same thing, at least, especially the ones that are private, because they have more freedom to do, to take on that's viewed as taking on extra risk in the traditional finance lens, because you're just increasing your exposure to Bitcoin even more. Like if Bitcoin crashes, then you also have this extra, basically the loan that you have to pay off, that now you have even less fiat reserves to do it because BTC crashed. But for everybody who's like long Bitcoin and in mining because they view it as a way to accumulate discounted Bitcoin, it makes the most sense to get rid of that, like you said, the possibility of having super inflated expenses.
Yeah, for sure. That's really interesting. So last topic here is around the hardware and the miners. And we've seen, here are some guys that are very, very passionate about S9s in terms of, especially for off-grid applications. And they talk about the firmware flexibility. They talk about the resiliency. They talk about just a lot of different things about why they like it. Here are other guys that are just like, that's just crazy. You're just making less Bitcoin. Why would you spend money? Even if it is a lot less capital, you're making, basically other guys will say you're going to lose because you're not getting as much Bitcoin. And then you think about, okay, we've got these different options of how do I make these investments in mining? Do I go with the older machines? Do I buy all newer stuff, S19s or the new Watts miners? Or do you do a blend? Is it a portfolio? And then, so that's one question, is just your thoughts around just kind of the different hardware there. And then also into the future, when are we going to butt up against the physical limitations? Like, will S9s have a runway? Some guys, you'll still say they've got a long way to go because there's only so much they can do even the next round, and that they're still going to be profitable. But, how many more rounds of this are we going to have where the new hardware can truly make these big leaps, I guess, is the second half of that question.
So the awesome thing about mining is that it's fully global, and the hardware can be relocated to wherever like the economics make the most sense for it. So with S9s, we've seen they were like first in China, and then a lot of them moved to Europe and North America. And then around the last halving, a ton of those S9s moved down to South America. And the reason for that, at least one of the big reasons for that, is that the miners in South America it's typically like individuals, not large companies. There's a few companies doing it. But they have access to really, really cheap electricity, but they have all kinds of other risks to do with, like, can you even get the hardware across the border without it getting stopped by customs? Right. Is the hardware going to be confiscated, for example, in Venezuela? That's a really big thing because now the Venezuelan government is mining with a bunch of confiscated hardware. So like the risk profile is totally different for miners in certain regions, and that's where it makes a lot more sense for them. Like the Venezuelan miners, the big risk is just having that hardware taken away or stopped at the border. So if you can get it across the border, then you've already won, because now you're printing money, and in that economy, like, you can make really, really good money with just a couple of S9s, relatively speaking. Whereas, in North America, where you don't have you have the private property rights, and you don't have that risk of confiscation or being delayed at the border and whatnot. Right. Then it makes more sense to go for maximizing your revenue, because your risk profile is totally different. Your main risk factor there is just BTC price and having huge financial contracts where you're going to be paying back the hardware over the course of like multiple years. Then you're just drawing your risk out a lot on that sense. But the upfront capex is not risky from the insurance standpoint of it. So this is what's really, really awesome about it is I do think those S9s will have a runway at least until the next halving, because there's the market for them in places where that risk profile is all about like minimizing the upfront capex, because that's your like 90% of your risk is just, will I actually get this machine and keep it for long enough that I can pay off that capex? But your opex is pretty insignificant. For the oil and gas miners, it's another really interesting thing, because like typically that waste gas is so cheap that you can mine very profitably with an S9. But yeah, then you're leaving revenue on the table if you could have consumed the same amount of power with a newer gen machine and made a bunch more BTC. I do think we've already reached a point where the hardware jumps are going to get smaller and smaller.
Yeah.
Or like not get smaller and smaller. I think they've already reached the point where like we won't see a hugely significant jump in hardware efficiency ever again. I could be wrong about that. Like maybe Bitmain or MicroBT has some innovation up their sleeves that they're going to get it down to like 15 watts per terahash on the next machines. But I think that we're already at the point now where like the current new gen hardware, the S19 generation and the M30S generation, barring some catastrophe with Bitcoin price where it just completely, the network fails, like I think that those machines will probably be viable for multiple halving cycles.
Yeah.
Like maybe 8 years, 9 years. And then the new gen after that, it'll be the same thing. And eventually we'll reach the point where we have like 4 or 5 or even 6 generations of hardware all mining at the same time, geographically distributed depending on those risk profiles and the electricity sources and et cetera that are available to people around the world. So, it's really good for decentralization as well, that, first of all, that stranded energy is geographically distributed. And then second of all, that there's this kind of, the governance differences around the world that impact the other aspect of the risk that will make it so that hardware is naturally going to continue being distributed.
Yeah, that's great. No, I think that's kind of how I was hoping the answer would pan out. I mean, I don't, as someone who is looking to different mining opportunities, it's a tough decision to make. I mean, if you could say that S9s were going to go beyond the next halving, I think it would be, and maybe they will in some degree, in some ways, if you have really cheap energy. But I think it's at least reassuring to know that if you're making an investment in the newer generation models, as long as they don't, if you can keep them running, there's probably a decent runway, because that makes a huge deal on these economics. I mean, if you're having to replace hardware every 3 to 4 years, it gets even riskier. So the idea that you could buy something and in theory get 5-8 years out of it, I mean, it makes a lot more sense, because then again, you can ride these cycles versus if you time it wrong and pay too much for the hardware and things crash, and then you've only got a couple of years till the next gen comes out. It really gets riskier. And so I'm glad that you share that viewpoint, because I'm hopeful that that's where it'll go too. And this has been great. I love getting into the weeds on the mining side. I've got to run here, and I'm going to be mindful of your time too. But Dan, I've really enjoyed this a lot, and I'm going to be following your work that you do into the future, and hopefully, maybe there's something else we can do content-wise, because this stuff is just incredibly fascinating to me. And it's funny, at the beginning when you were talking about the Bitcoin bug and catching it, it's like ever since I've gotten into the mining side and learning about this stuff, it's just addictive, because it's a rabbit hole that goes very deep, and I like complex problems. I think they're fun to try to solve, and so this has been really enjoyable for me, and I appreciate you doing it.
Likewise, Max, I'm really glad you had me on, and I'd love to do it again sometime. Like it's much easier to be able to riff rather than having to write an article, because the article is like 90% of the work is getting it to be somewhat concise. To just be able to talk freely is really fun. So yeah, I had a great time.
I can't write. Props to you. Props to you for doing that.
Thanks.
It's hard for me to write. I think I'm impressed by when people can do it, because I'm a talker and I can't get it done.
It takes a lot of practice, for sure.
Yeah. Thanks again, Dan.